Welcome back to our series on economics, finance, risks, and tax strategy. Today we'll dive into the topic of negotiation in acquiring a business that comes with a real estate acquisition and how to secure a great deal. Negotiating a business acquisition with real estate can be a complex process, but with the right approach, you can come out on top. Let's start with a real-life question from the audience.
Yeah, okay, so this is the cash flow and price they are asking. The way I look at it is, and the more I look at the numbers, let me see if I can get the investment analysis and pricing, also the detailed analysis of what the value should be. That is, now I have just generally the figures and price they asking. What should I do?
Do a basic research on the business and real estate. Once you have done your research, it's time to prepare for the negotiation. Set clear goals and determine your priorities. Decide on the maximum price you are willing to pay for the property and identify any contingencies or deal breakers. This will give you a clear framework for your negotiation strategy. Come up with your values as an investor. Here you will need a deeper analysis of what they have done. You may not be able to use their model or analysis to make that determination. To have a great deal, you have to do this for yourself and determine what the numbers are. Then there will be one of three scenarios or cases you will find yourself. Scenario one, you see the same value as they have presented. In this case, you can have a convergence or a negotiating point on the basis of what they've sent to you. Scenario two, you see better numbers and higher value than they've seen, in which case you don't show it, but you want the negotiating process to progress quickly to a conclusion so you can move in and realize that potential value for yourself. Or scenario three, you see worse than what they see. In this case, you try to negotiate it back to where you think the right price is. So, let's take a look at the numbers as you are presenting them. It's probably easier to make a determination if we're able to see the model, whether it's appropriate. What I'm trying to say is that the way they've structured it, as you've shown the net operating income, what remains in the due diligence is to ask, do you accept the net operating income as presented on the basis of the expenses? If you accept it, then you just look at comparable real estate in that market, or look at cap rates, and then you do your own valuation. If the cap rate you have in mind is not different from the cap rate they have presented, then you're going to come to similar value for the real estate, and you may accept it.
I don't understand what you mean. Sorry, my bad. Please, can you break it down?
During the negotiation, it's important to be professional and respectful. Remember that you are dealing with a person who has invested time and effort into their business and property. Maintain open lines of communication and listen carefully to the seller's perspective. Building a good rapport can go a long way in reaching a mutually beneficial agreement. So breaking it down here, separating the business from the real estate is key. What I'm trying to say on the real estate valuation is this. You look at the net operating income the seller has given, okay? You look at the cap rate they've used in their analysis to arrive at the value they presented. Then you ask yourself the question, do you accept the net operating income? Yes or no? If yes, then you move to the cap rate. Do you accept the cap rate they've presented? Yes or no? If yes, then you have your current market value. In this regard, if you agree with the seller on the cap rate and the net operating income, you're going to arrive at similar perception of current market value for the property, simply because the current market value of the real estate portion is pretty much the net operating income divided by the cap rate. Having similar valuation, you can now say, okay, well, it means that they've tried to clean up everything on the table if the cap rate and the net operating income you see are similar. And it means that the pricing is efficient. It also means that they are probably not leaving anything on the table for you as a buyer. So all you're left with then is to say, hey, leave something on the table for me. Great. Now that is your negotiating or persuasion objective. Now let's consider scenario two. If you agree with them on the net operating income, but you disagree on the cap rate, and if your own determination of the cap rate is higher than the cap rate they used, then you perceive a lower value for the real estate than they have presented. However, if your cap rate is lower than their cap rate, then you perceive a higher value in the real estate than they presented. In this case, you want to quickly close the deal calmly without showing too much enthusiasm. You see, it's like buying a stock in the market. If you accept the current ask price, then you perceive higher potential present value than the seller, and so you buy it. If you perceive lower potential present value, then you try to bid lower than the ask price. Concluding on the real estate portion. Next, you look at the net operating income presented by the seller, and you do your analysis of the revenue and operating expenses. If you disagree with the net operating income, the question is, why do you think they are not credible or inaccurate? Do you think that the actual net operating income is lower than what they have presented on the basis of your test of the expenses? If you perceive lower net operating income, then you bring it to attention and get them to explain where the discrepancy arose. The due diligence questions on completeness, accuracy, credibility, and relevance of the financial data should potentially get you more insight on the robustness of the financial information. However, if you conclude that you can make the net operating income higher than they have reported because you identified opportunity to lower or be more efficient with the operating expenses, then it means that your investment value is higher than theirs. In this instance, you should probably move swiftly and conclude the acquisition and move on. What remains is to work diligently to realize potential value you have perceived in the operating income, so that's on the real estate. Focusing now on the business side of the transaction, you generally follow a similar approach. You start off by asking the question, given current market conditions for that kind of business, is the EBITDA margin and turnover presented by the seller different from your perception of these measures of viability? Given the level and type of asset used and the market in which business is operating, is the revenue appropriate or adequate? How are the sales and revenues generated? Is it primarily as a result of current owners' social capital or personal relationships? Is this turnover what the market is able to sustain? Do you have the capacity to increase the revenue through sales, marketing, and other business development efforts? Can you improve the asset turnover, which is one of the key elements of return on equity? If you can increase the asset turnover, then you proceed to look at the EBITDA margin and ask, can you do better in terms of operating efficiency? If yes, then you can realize some potential value. You can then proceed to look at what they are currently paying as interest expense. Measure that against the total liability and separately against the long-term liability and ask, is debt services too high or low? Are they paying too low or too high to service interest payments? Is your credit rating better than the credit rating of the business to enable you attract lower interest rate? Do you have access to financing at a lower interest rate? If the answer is yes, then potentially you will pay lower debt service charge than what they are currently paying, which means you get some money in your pocket again. This is how you proceed to look at what they pay for taxes. You ask, what are they paying and what is the net profit compared to the tax they are paying? This is the tax burden. You ask, can you structure to be more tax efficient? Can you engineer this in the way that you pay lower taxes, or you make the tax more efficient? You see, each of these questions will lead to either higher value or lower perceived or potential value. The leverage question is, what is the current leverage ratio? Is it adequate? Can you restructure or attract the same debt with lower equity? If you take out that equity and that equity is in your pocket, can you leverage higher to ramp up the impact of other components of the return on equity? So this is how you go about asking the questions to answer the ultimate question. Is this the right investment and how much should you pay for it? When making an offer, be prepared to justify your proposal. Highlight any value-add opportunities or improvements you plan to make to the property and business. This can help justify a lower offer or provide leverage for negotiation. Additionally, consider offering alternative forms of compensation, such as seller financing or a percentage of future profits. These creative solutions can make your offer more appealing to the seller. In conclusion, negotiating a great deal when acquiring a business with real estate requires careful preparation, effective communication, and a willingness to explore creative solutions. By doing your research, setting clear goals, and maintaining a respectful approach, you can increase your chances of securing a favorable agreement. Remember, negotiation is a skill that can be honed over time, so don't be discouraged if you don't get it right the first time. With practice and experience, you'll become a master negotiator.